Testing. Can you hear me, Lynn?
Can you hear me?
Yeah, perfect. Awesome. Well, good
Awesome.
to know Zoom works, eh? After dropping, was it $1,000? How much did you spend on this?
It was a lot. Not a number that I feel comfortable disclosing.
Good
It
thing
was quite a
people know
bit.
it.
I mean, it better work well. Otherwise, we'll be pretty upset. I see some people starting to join. That's awesome. Roderick is here. Munir is here. Hello, Munir. Gabriel, battery, perfect. I want to make sure the chat works for everyone. If you can, guys, just post a quick hello in the chat just to make sure everyone's able to use it. That'd be super great. I'll start by sending you a quick hello. Badri is here. Awesome. Gary, Thomas in the house. I love that Thomas is here because we use Thomas's case study in our pitch, usually in our pitch deck. So Thomas, you might see a photo of yourself. I'm not sure if Martin, you have added that into today's presentation, but Thomas, you might see your photo and yourself in it.
Right.
Awesome.
And would you be able to enable the chat function? I think people are saying that it doesn't work.
It doesn't work?
Yeah.
All right, let's do that. Yeah, I was like, I don't see any text coming in.
You could
Let's
also
see.
add Roderick as a panelist. I think that would be helpful too.
Absolutely. Perfect. So it should work now. If you guys can just send a quick hello into the webinar chat. Perfect. Hi, Gary. Awesome. Perfect. Awesome. Hi, Munir. Oh, Alan is here too.
And give probably
Perfect.
another minute or so.
Yeah, let's give a couple more minutes. I've just resent the link again to make sure that everybody had it. And yeah, let's give them a couple more minutes to join in, and then we'll get started with this exciting opportunity. Did everyone here receive my emails? Is that why, or is it someone else that sent you the link? Could you quickly tell me in the chat if it's through email, just write email. If it's through someone else, just write someone else. Just to give me an idea of if what I'm doing is working. Awesome. Terry has joined. Hi, Terry. Oh, it's good to see you guys. I'm glad so many people are joining. Thank you, Gary, for your response. Awesome.
Could you add Roderick as a panelist? You can. I have no idea how to do this, guys. This is Olin.
Let me quickly change that for you. Oh, there he is.
Then also screen sharing needs to be enabled.
Yes. Perfect. Let's do this screen sharing. So it should already be, you and Roger should already be allowed to share your screen. Could you double check that for me?
I cannot.
Hey guys, can you hear me okay?
Yep.
Yes.
Awesome. Cool. Okay, so I can talk. I can't share my screen or turn my video on.
Yes, I'm changing that right now. Make sure you have that. Perfect.
Got it.
Also, I feel like Gary is the only person who responded. Guys, I was just saying earlier, if you've received my emails and that's why you're here, if you can just chat in the chat, just write email. And if it's someone else that told you about this, I sent you the link, just write in someone else. So just to give me an idea of how you guys got here, see if what I'm doing is working. I know there is two Martin Mays because I'm using Martin's account as the host, and I have Martin as a panelist, so we're both using that account. I know. Awesome. Email received. Perfect. Awesome.
All right, let's get started.
Yeah, let's do it.
Perfect. Well, thank you so much, everyone, for coming through to the webinar. We have really exciting news we want to share. Essentially, we have been working on this deal for the past couple of months. we've actually rejected 3 other deals that are very similar. And we finally landed on this. This one we are ready to share on the deal level what it looks like, as well as the overall self-storage concept. So if you had a one-on-one with us before, it'll be very similar information, but this could be a really good refresher. Or if you never had a one-on-one with us before and you knew us from back in New Brunswick days, we've been working on this for the past year consistently, and our team has grown to more than just me and my wife, Lynn. So super excited to give you guys an update. This webinar will be done on a weekly basis. And also throughout the week, we'll also have other types of information that we'd like to share in the webinar format. But super stoked to be here with you guys. And thank you for bearing with us, as this is our first time doing a Zoom webinar. But anyways, let me get started. So we're obviously not attorneys, we're not accountants. It's purely for informational overview only. And interested parties should definitely perform your own due diligence to make sure that all the grounds are covered. And this is something that makes sense for you on the tax and the legal side. And Canadian investors are able to participate through a Canadian LP structure. American investors are able to participate through the American LP, because I know we have people from both sides of the border and even internationally. So we have definitely gone the distance of setting everything up properly. So that's the most tax efficient and legal way for you guys to be a part of the deal. So essentially, who we are as Meily Investment Group is we are a private equity real estate firm. We develop institution-grade property self-storage facilities in underserved growing markets in North America. The strategy that we have is we're leveraging market research, we're working with industry veterans, and we're also working with institutional partners to ensure the projects that we have are successfully completed. And who do we serve? We really see ourselves serving the everyday investors, right? We like to serve people who are not at the institution level, people who are simply looking to invest in real estate opportunities that usually only institutions have access to. Because more often or not, we usually see the everyday investors, right? They only have access to short-term rental arbitrage, they do single-family rentals, they do duplexes, fourplexes, but in order to buy something of a massive self-storage facility or a massive multifamily facility, the 20-25% down payment that equals to hundreds of thousands of dollars or even upwards of millions of dollars. Most everyday investors don't have access to that kind of opportunities, but those opportunities are extremely safe, are extremely secure, and those you get to play on the institutional level. So we're essentially breaking down the barrier, and we're empowering the everyday investors to be able to invest in opportunities like that. So what we used to do is we used to operate in the multifamily asset type in Eastern Canada. We used to turn properties that look like that into something that looked like this. We work with the local government authorities, we work with CMHC programs to provide improved housing options for our local community in Eastern Canada. So how we used to do this, Thomas is actually in this call, but we used to work with people like Thomas, who's a busy working professional that has some savings, has some borrowing power, but instead of buying a condo or a single family asset in a primary market such as Toronto or Montreal, we'll partner up together to buy a fourplex in Moncton, which is considered a tertiary market in Canada. So what a deal would look like is we'll buy it for $340,000 as a purchase price. Down payment plus rental will be around $100,000 all in. After doing the renovation, we're looking at a new valuation of $540,000. So we do a cash out refinance. We do what's called a BRRRR, right? Essentially, we're able to BRRRR out the investment that Thomas made, which is $100,000, because the cash out refinance portion is $160,000. So what that means for Thomas is the initial investment that he made, it's completely pulled out through a capital repayment, and he also get refi proceeds on top of that. And we also have a cash flowing fourplex that he has no money left in the deal. So we did that across New Brunswick. We did that over and over again. We bought fourplexes, we bought duplexes, we bought short-term rentals. We also bought, a bunch of these portfolio in St. John and Moncton. We had investors that were really happy. We had sellers that found us really easy to work with because we're able to work with their timeline. We're able to work with their special situations. So these are just some of the track record that we have. In order to target more off-market distressed sellers, we even had TV commercials. We had the spot after Dr. Phil every night. We were featured on different podcasts. We're super, involved with the local chamber. We also bought billboards all across the province, right? So this is how we felt. This is how our investors felt. We felt like, we're able to do a BRRRR. We felt like we discovered, this great market. However, bad news started to be delivered to us by our property managers. Ground Floor, which is among the top property managers in Moncton, New Brunswick. We're working with the top of the top in that market, but things still happen. They started to tell us, hey, there's a mold issue with one of your units. And the tenants left the fridge in a nasty condition, even though if you just bought it. And you have to replace the fridge. The roof started to leak. And a kitchen that we renovated just caught on fire. So, and these were just some of the damages that our property manager would send us. And obviously we have to share this information with our investors, such as Thomas. And we felt like it was extremely stressful for both us, also for our investors as well. We tried short-term rental because we felt like maybe it's easier to manage the tenants, manage a residential property if we do short-term rental. While the short-term tenant clients also had their own types of complaints, right? So this is really how we felt. If we felt like the more we grew with our investors, the more headaches we have to deal with. So our mission has really evolved since then. Our goal has always been to provide excellent real estate opportunities for an average real estate investor, for average retail investor. But we wanted to be really passive this time with no headaches and really predictable income. And for the love of God, if we have 2,000 units, we don't want 2,000 toilets that come with it. And the whole idea of passive income, I know most of the people in this chat, you guys are working professionals. Lynn and I, we used to be working professionals as well. But the whole reason we got into real estate is the concept of, if you don't find a way to make money while you sleep, you will work until you die. So either you're investing in real estate to replace your 9-to-5 income or simply for capital preservation. We definitely believe in the power of building that passive income stream, either through real estate, through, drop shipping, through whatever it is that people do nowadays. We just much rather, play in the real estate game. So what we're currently doing nowadays is instead of doing a small time JV, we're doing syndications. And this is what, a deal looks like for the deal that we have in El Paso. We're usually shooting for a 3 to 5 year hold period. And we're essentially having our investors invest into our LP structure as limited partners. That way they're protected from any liabilities that come with owning a commercial property. And they're able to take advantage of this syndication where we're pulling together essentially money for the down payment to be able to afford this massive institution grade property. How did we get here exactly? I mean, most of you know my wife, Lynn, she's in this picture. We went to this event in Florida. We're surrounded by people that were probably 30 or 40 years older than us, definitely 30 and 40 years older than Lynn. We found out, from talking to them, most of them has been doing, multifamily their entire lives. And they were trying to pass on their wealth to their kids. And their kids are like, no, I don't want to be a landlord of, thousands of homes. They much rather do something that's a lot easier to manage, that doesn't involve, managing people's homes. Like that's a lot of life or death responsibilities that you have to deal with. One gentleman here, he actually had 12 Subway restaurant franchises. So, business owners, multifamily owners, and they were all trying to get out of it as they got older in their life. So that ended up being a self-storage event. They were looking to sell their assets in multifamily and other businesses to get into self-storage. So we were scratching our heads. We're like, hey, what's going on? And we found out over the past year that, self-storage as an asset type, it's easier to operate because of all these different reasons. And also as an investment, it's extremely secure for so many different reasons that are superior than multifamily too. So I'm going to dive a little deeper into this. It will likely take about, 10 minutes or so for the rest of the presentation. So, just a quick time check for everyone that's involved. But when it comes to landlord friendly, how we evaluate this is we look at eviction processes, the tenancy laws. If a tenant stops paying rent in self-storage, we can simply put a second lock on their unit. If they still don't pay after 30 days, we put their stuff on storageauction.com. That's why we have a TV show called Storage Wars. Now, to turn over a unit that looks something like that to something like this, it takes 30 minutes. Now, to turn over a multifamily unit, which we've done many different times, it takes at least 3 weeks. And sometimes there might be delays as you're opening up the wall for renovation. It could take even longer. And those are the time that you cannot rent it out, right? Those are the lost income due to the vacancy. Now, we decided to partner up with REITs. The reason we are doing that is because if you look at the industry market share, the biggest REITs, which is public storage and extra space, they only control less than 10% of the entire market. So in order to compete, in order to consolidate more market shares, other than building, other than acquiring, they're also doing third-party property management. So they're charging only a 4 to 6% management fees, plus the salary of the employees they will put into our facilities. The reason we do that is if you Google self-storage near me, you're not going to see any mom and pop operators that pop up. You're not going to see, Martin and Lynn self-storage. You're going to see Smart Stop. You're going to see Extra Space. You're going to see Life Storage. These REITs have millions of dollars in ad budget to be able to compete for the top spot. So by getting CubeSmart to be our property manager, we get to leverage their marketing, we get to leverage their infrastructure and their brand equity to compete in the space. So they will treat our facility as if it's one of their own and market it and manage it as is. So by partnering up with them, they are also giving us revenue projections with real-time data. They have facilities in El Paso, Texas right now around the site that we're looking to build. So they know exactly how much it costs on a personal level, and also in terms of how fast it takes to lease up the units that we're planning to build. So they're adding a lot of value as our property managers. This is very comparable to, if you're looking to buy a multifamily unit in, let's say, Alberta, and you call up a local property manager, you ask them, hey, I'm looking to buy this, fourplex, and they're 2-bed, 1-bath. How much do you think I can rent it for in this neighborhood? The property manager is going to give you a very conservative outlook, just like the way CubeSmart is doing for us. So they're essentially trying to use real-time data as realistic as possible to give us a revenue projection. And based on their projection, at the end of year 3, at the end of year 4, we should be looking at the net operating income of around $1.2 to $1.5 million. And that's based on the real-time data they have. Now, the fact that we're in self-storage, we're essentially operating a business that's real estate based. So we get to sell, U-Haul, truck rentals, we get to sell moving supplies, mandatory tenant insurance. We can even run the UPS store franchise out of that facility too. Now, let's look at the demand. People love to hold on to their stuff in the US, and the consumer culture, it's a lot more consumer focused compared to Canada and compared to the rest of the world. So that's why, from a residential and the commercial level, people need self-storage. However, during the recession, when people are getting divorced, when people are going through bankruptcy, when people lose their homes, they're not going to give away their baby's pictures, their baby's clothes. They want to hold on to them, right? So if they downsize from a 3,000 square foot house down to a little 1-bedroom condo because of a financial crisis, they're not going to get rid of their stuff. They're more than willing to, pay $100, $200 to store all of their belongings just in order to kind of wait it out, right? So that's why we see the tenants being extremely sticky. These are all numbers, from the Self-Storage Association in the US. And we see residential tenants tend to stay around 16 months, commercial staying around 22 months. Now, it's extremely data-driven. I see a lot of the attendees here have actually invested with us before. So in multifamily, it's very much, we have to check with the property managers. There is some data platforms such as CoStar that we can leverage, but in self-storage, it's down to the square foot per capita. That's the benchmark we usually look for. We also look at the rates, we look at the population density. There's so many data points that we can track in order to determine the demand, the rental, the lease velocity, and also the revenue projection of our facility. So this site that we are looking at, we're seeing there are only 2 stores in the 3-mile radius, according to this platform. So 2 other competing self-storage facilities are in the same 3-mile radius. And we get to serve around 57,000 people who live in the 3-mile radius from here. And what we do then is we order a feasibility study because we realize, okay, the square foot per capita is only 2.55. The national average is around 6 or 7 square foot per capita. So on paper, it seems to be a really underserved area. So let's verify that. Let's order a feasibility study. We found out that 2 competitors that are in the same market, they're running at 98 to 99% occupancy. So that means if Lynn and I, we live in this part of El Paso, Texas, and we're trying to move, we can't even rent a self-storage unit. They're almost 100% booked out. That's how in demand this area is for self-storage. What we also found out is in terms of the square foot of the total square foot of self-storage that's needed, this market needs total square foot of 844,000 square foot, but the total supply, there's only about 100,000. So there's an excess demand that's been untapped of around 739,000 square foot. And remember, guys, we're only building about 80,000 square foot. So technically, if we build 9 or 10 of these, we're still barely hitting the equilibrium of what this market needs. That's how we calculate the demand in self-storage. It's extremely mathematical, and it's extremely, very much data-driven. The ease of construction too. Lynn will probably, get some PTSD from looking at this, but because she used to manage all of our construction, sheet metals and concrete versus plumbing, drywall, insulation, electricals, all the plywood. So it's night and day difference. Because of that, building something like this, a multi-story climate control self-storage facility, it usually takes, it costs a fifth of how much it takes to build a multifamily building. The scalability aspect too. The biggest building we have, it's a 6-plex or 8-plex, but with a self-storage facility of 750 units, any little change in your rent per unit makes a huge difference because of the scale, right? If let's say we have 750 units, we're increasing the rent by $20, a mere $20. So it goes from $100 to $120. I'm not going to move out for a $20 increase. It's not worth my time, right? It's too much trouble. But if you do that across 750 units, that's a $3.2 million increase in the valuation. So what that means is that because of the scalability, we don't have to raise the rent by that much. And we're not raising rent on people's homes. This is like among the lowest expenses that people pay on a monthly basis. This is comparable to a car insurance. This is comparable to, this is even lower than a car payment. But if you increase the price on their rent, on their primary residence, that's when they freak out. That's when they have a lot of pushback, right? So we are really tapping into the consumer behavior part of real estate as well. We don't necessarily want to be in the residential business because that's where people, relate to a lot more. That's when people get stressed out even more. Self-storage, this is very much a commodity. This is a commodity that people need for their everyday life. We also leverage bonus depreciation as a strategy to lower, our investors' taxes as well. So what we do is we order a CPA to do a bonus depreciation study to really calculate exactly how much of the asset that we can use to accelerate that depreciation for our investors. And we pass on those savings for our American investors. Now, the exit strategy, the reason we're in the Class A self-storage development game is because we realize that REITs and professional operators, they only control less than 30% of the entire market. The rest of it is on mom and pop, and we're talking about the US. So what that presents as an opportunity is the fact that these REITs are aggressively trying to expand and consolidate the market. So we see that Manhattan Mini Storage is sold for $3 billion. Life Storage is sold for $12.7 billion by Extra Space. Public Storage is out here buying portfolio after portfolio. And if you look at this graph from CoStar, you're able to see over the past 20 years, private, which is in blue, the private investors are starting to sell their self-storage facilities. And guess who's buying? It's the REITs, the public companies, the institutional self-storage operators, and the private equity groups. That's really the biggest opportunity in this game. Is the fact that we have we have a product that these massive institutions want to buy, and these massive institutions are competing with one another, trying to consolidate from our market shares. Let's look at how these REITs have been doing over the past couple of years as well. We see that they've consistently outperformed the S&P 500 and Vanguard real estate ETFs. So what we're doing here is we identify that Class A is the type of facility they want to go after. So we identified a site in El Paso, Texas that fits all of the criteria, and that it's extremely safe, in fact, it's actually the largest, it's the safest large city in America for Americans to live in. And according to CoStar, the population growth has been extremely stable and extremely steady. So we identified this site to be a site that REITs want to manage, potentially want to buy. We're minimizing the development risk by partnering with people from self-storage income, from storage syndicate, which are the two biggest self-storage groups in the US. We're also working with coaches from Fund Launch and also other fund managers who are part of the Fund Launch program, and also Well Genius, which is the largest Canadian multifamily group. Because of the size of the deal, we have to work with institution-grade due diligence. We're not working with, Sherry Lynn in Moncton or someone from Alberta. We're working with these publicly traded companies that are doing the due diligence for us. So CubeSmart is going to be our property manager. We're working with Marcus and Meily, for the valuation of our facilities, working with engineers from Colliers that are consultants who hire and work with on a weekly basis to really make sure that our project comes to completion successfully. By building brand new, this is probably the most common question that people usually ask us. Why are you building brand new? Why are you not just buying existing? Well, by building brand new, we're able to study the market and provide the best product market fit. If we find out that this market needs more 5x5s or 5x10s, we're going to capitalize on this unit mix a lot more than the 20x20s, because we're able to really study the market and build exactly to what the market needs. By building brand new, by buying raw land and turning it into self-storage facilities, that presents us multiple different exit strategies. The fact that we can just sell it as a piece of entitled land as soon as we go through the entitlement process, that essentially is a really good way for us to stay very nimble throughout our development process, especially during a time like this, right? The interest rate are going out of whack. We don't know, we cannot predict the future. So the fact that we have different exit strategies, it really puts us at a really good spot for us and also for our investors. We could sell it as soon as it's built. We can sell it to, if we're planning to sell this to CubeSmart's competitor, we can fully do that. Or we can sell it or refinance during stabilization. That presents, to us as operators, multiple different ways that we can get paid from the deal. Now, the team that we have put together beyond, just me and Lynn, we're working with Roderick. He works in corporate strategy for Hudson Bay Company. And he also did corporate strategy for RBI, Restaurant Brands International, which is a parent company of Tim Hortons and Burger King and Popeyes. We also had the honor of working with Gabriel as our compliance officer. He worked for KPMG as a CPA, and he also used to serve on the Quebec Securities Commission. So with the extended GP team that we have, we're leveraging people that's been doing this for a long time. Barry Sherman has been doing this for the past 25 years, developing Class A facilities for CubeSmart, managing the design process, the development process, the entitlement process, all the way to completion of the construction. Joe and Brian, Joe used to be a US Navy, and Joe and Brian together, they run a $50 million self-storage fund. So technically we can just go to them and get the deal funded, but we're much rather, dealing with our own investors. That's why we're holding this webinar. We'd love to essentially give this opportunity back to the investors that we're currently working with, or we've worked with in the past, to really show you guys the progress that we've made in the self-storage industry. But yeah, we can always go back to Joe and Brian to tap into their fund to fully fund our deals as well. The process of what we're doing here is we're doing deal-by-deal syndications to start, and we have the ambition to also start our own fund as well. So we can raise the money and allocate, our fund into different projects so we can further spread out the risk for our investors. Now, what our deal looks like, right? Just from an overview level, it's a ground-up development. That's where our investors can really see the largest equity gain. However, there's really no cash flow until the project is stabilized. And we're planning to hold it for around 5 years. We're doing a pref model, right? GPLP structure. Now, how much of the property would be worth? The net operating income, based on a feasibility study, based on our own underwriting, should be just over $1 million at year 3. So as a worst case scenario, let's say we're looking at a 6% cap. I actually just shared an email from Marcus and Meily to my team earlier today. There was a facility managed by CubeSmart in Atlanta. They're only 50% occupied. They're trying to sell it at a 1.5% cap. So this is really like, we're being extremely conservative here. If at a 6% cap, we're looking at a $17 million valuation. Conservatively, right, this is how we'll be underwriting. It's at a 5.5% cap. And the likely scenario, it's at a 4.5 cap and below. So just remember, we're only building this for $13.7 million. So there's quite a bit of spread. And this is really what excites us the most about being in this asset type and in this class is the fact that there's a lot of upside from the exit. Now, the waterfall structure, for those of you that's never dealt with this before, this is really on a high level what it looks like. Let's say, we defined our waterfall structure to be 8% pref, 70-30 LP-GP split. The investors will be the LPs. Us as the operating partners will be the GPs. 8% pref stands for preferred rate of return. So from a sale event or a refinanced event, this is how the capital stack gets paid back. We pay back the capital of the whatever investors put in. If they put in $50,000 or $5 million, they get that capital payback first. And then from the 0 to the first 8% of the deal, let's say the deal generates 24%, 0 to 8%, it's paid out to the limited partners. So this is actually way better than the BRRRR model that we used to do, because before in the BRRRR model, we simply pay back the capital and then we split whatever is left over. In this scenario, we pay back the capital and the first 8% is paid back to our limited partners. Now, only after that first 8% is paid out, anything after, it's a 70-30 split, meaning that if we make any additional dollar after the first 8%, 70 cents out of that dollar goes straight to the investors and 30 cents goes to us. What that means for the investors is your interests are extremely protected, because if the deal, let's say something were to happen and the deal only generates 6% or 7%, the GPs, we don't even make any money from this. So it's in our best interest to really push this to as far as possible, because that's the only way that we're getting paid from this carry interest. Now, what could go wrong? This is, one of my last slides here is natural disasters. Let's say, thankfully we're Canadians, so we're extremely conservative when it comes to natural disasters. We turn away a few deals in Florida, as attractive as it may sound. I really think, the hurricanes are only getting worse. So I don't want to deal with any of that. I don't want my investors to deal with it. So we look at earthquakes, volcano, tornadoes, and hurricanes, and El Paso scores extremely low, meaning that it's extremely safe compared to the rest of Texas and the rest of the US. Overbuild, new competition. As I said, that's a huge risk when it comes to self-storage, because it's almost like a grocery store. You can't have too many grocery stores in the same market. But when we look at the demand, as I said earlier, this market needs an additional 700,000 square foot of self-storage. Now, we found out, by doing the feasibility study, one of the competitors, they're actually building an extension. They're building $12,000 more self-storage. And that's a drop in the bucket, right? So technically, let's say there are 8 or 9 other facilities that open up along with ours. We're still barely hitting the demand that this market needs. Economy crash, the cap rate. Let's look at what happened during the last recession in 2008. Self-storage was the only asset type that didn't suffer a negative quarter throughout the 2008 to 2010 period. And that's very much because the self-storage demand, it comes from when things are going well and also when things are going terribly. So it's a bit of an interesting concept to think about it, because self-storage ends up being a really good way to hedge against a recession, to hedge against inflation, and hedge against an economic crash. Let's say if it takes longer to lease up, let's say CubeSmart totally messed up their projection, and it actually takes way longer to lease up, where we're not able to refinance because the interest rate is just like double digits. Well, guess what? We have a facility that's going to generate over $1 million in net operating income per year. We're just going to hold on to it, right? And we're going to keep on refinancing whenever we can to pay out that pref until we can meet that 8%. But as I said, this is really just what could go wrong. This is a list of things that could go wrong. Let's say if the REITs stop buying, that's fine. We're just going to hold on to it like we held on to the rest of our New Brunswick portfolio. Just hold on to it as cash flowing assets that we can pass on for our future generations. So that's really, the end of my presentation for now. feel free to scan the QR code if you are not already on our list. You know, you guys should probably already have my email or phone numbers. Feel free to, you know, ask any questions, you know, individually. Feel free to reach out. We can probably have like 2 minutes or so as a Q&A here. What do you think?
Yeah, so I actually just kind of launched a quick poll. If you guys have, if you guys can see it, it's at the bottom, usually on your kind of like utility bar at the bottom. There's a quick poll you can go and answer. There's a quick question there for you guys. But in the meantime, feel free to add in any questions that you have in the chat, and I'll be able to kind of go and get them and make sure that Martin answers them all. But thank you, Martin, for going through all the information. I think that was super informational. Is there anyone here that it's the first time that they hear about this? If this is your first time ever hearing about this pitch, or you never had a one-on-one call with us, if you can just write me in the webinar chat section. So, first, awesome. Batteries answering first time. Yeah, if you can write first time in the webinar chat section, that would be super helpful for us to know if this is your first time. Yeah, so Martin, why don't you just spend maybe a little more time talking about the team, the people that we're working with? Because other than just us on the internal basis, we're actually partnering with a lot of industry veterans in this space to make sure that our projects are taken care of. Could you dive a little deeper into their experience?
Yeah, absolutely. I would love to. So let me just share my screen again. All right. So from a GP level, I think I briefly mentioned, you know, we're working with industry veterans that's been doing this for a long time. So, you know, that's including Barry Sherman, Joe and Brian. So, you know, I'm just going into my Google Drive here. So legacy developers, that's what they're called. That's the company they have. So we get to leverage the resources they have put together over the past couple of years. They recently launched a $50 million fund to do exactly this, right? That's why our interests are very much aligned, and we're very much working with them to do the deal with us. So this is just a sample, like this is a deal that they recently launched in New Jersey. Last week, they also just opened up another site in San Antonio. To be honest, guys, it's not that sexy. It's literally a cookie cutter. Like it's really sexy for me and Lynn and Roger and Gabriel, but it's self-storage properties, right? So you have your temperature controlled portion. You also have your drive up portion right here as well. And it's not, you know, everything here is done by design, but meticulous, you know, feasibility study and demand study. So essentially, you know, based on the feasibility study, they're able to determine, okay, we need, you know, this many units of drive up. We need this many units of temperature controlled to really optimize what they have as a piece of land. That's a picture, you know, of the ribbon cutting ceremony. So very solid team based out of New Jersey that we had the pleasure of working with. And on our immediate GP level, you know, we're obviously making sure our Canadian investors are taken care of, our US investors are taken care of. So that's why we have, you know, a securities compliance officer that they used to serve as a securities compliance on our team. And Gabriel actually coaches other emerging fund managers and other syndicators in real estate, in private equity, in all kinds of different businesses. But we decided to give Gabriel, you know, more than just our advisory board. We want Gabriel to be part of our GP as we are launching our private equity model. So yeah, that's the team that we put together. I definitely think this is a, you know, all-star team that has what it takes to really take it to the next level.
Awesome, thank you. And I have another question here from Thomas saying, you know, what's the timeline for the legal docs to be rolled out? What are the next steps? How can we get involved? What do we need to do from now?
Yeah, so in terms of legal docs, we're just making some of the final changes, but the legal docs should be ready for the first week of July, which is actually next week. So by the end of next week or the week after that, that's when everything will be ready. So that's when we will be able to share that with our investors. So you guys can take the time to review, to take the time to digest it. But everything about the deal, the business plan, everything about ourselves will be listed on there. So it is a lot of information to go through, but essentially we're planning to give our investors, you know, about a week or two to really review that. And then the capital call will be in mid-July. Yeah.
So yeah, so guys, if you'd like to receive further documentation as soon as it's available, just send me a quick chat. Just say I do in the chat, and I'll make sure that everyone receives all the information after everything is ready. We're gonna be hosting another one next week, usually this probably the same day. I'm gonna be sending out more emails about that, so you guys will be all informed about it. I'm gonna add a little more details. And if you have anyone else that you think would be interested into this that hasn't been on this call today, feel free to send that over to them. Or you can also email me their information or put me in contact with them, and I can make sure that they have all the info for next week as well. Yes. So if Martin, could you maybe just put on the QR code again? It looks like yeah, we haven't had the time to scan it yet.
Absolutely. Yeah. Sorry, I always get too excited and then jump to different slides, but here we go. But yeah, no, if you, thank you for coming to this webinar. But as Lynn said, we are planning to do this specific webinar on a weekly basis. So if you guys want to, listen to it again, you can always do so. But during another time of the week, we'll also have, other information that we'd like to share as well. So just watch out in your inbox. Feel free to reach out to us directly if you have any questions. As we grow this, we're likely going to have a designated, investor relations rep, someone that you can just go to. But in the meantime, feel free to reach out to anyone on our immediate team member, and we'll be able to address any of your concerns.
Awesome. Yeah. Thank you everyone for joining. Roderick, do you want to add anything?
Nope, all good on my end. My only question is, for some reason, someone stopped my video, so I'm not exactly sure why I can't share that anymore.
I know it's my fault. I'm sorry. I did it without realizing. I wasn't trying to do that. I apologize. I'll make sure next time you have your video on.
Yeah, I was worried I did something wrong there, but no,
No, you
all
didn't.
good from my end. Hope this was helpful for everyone here. And like Martin said, if any questions, don't hesitate to reach out to any one of us.
Perfect.
Yeah. Yep. Take the time to take a photo, and then we'll gonna be logging off as soon as everybody's off the call. But thank you guys.
Thank you. All right, let's end it. See you guys soon.